Donald Trump's election as US president has kicked off an absolutely extraordinary moment in global bond markets. Here to talk about it is Laurence Mutkin, who is the head of G10 Global Rate Strategy for BNP Paribas. Laurence, thank you so much for joining us. So we have our first chart. Can you explain what it is that we're looking at here?
Yep, well, we're looking at the 10-year Treasury yield, and we're looking at this pretty dramatic 40 basis point sell-off that we've had since the election result.
And why did that happen in the US?
Well, for one thing, I think the market was surprised by the outcome. And for a second thing, it seems that Donald Trump's fiscal policy is very expansionary, which means more government borrowing and higher nominal GDP growth, both of which should be bad for government bond yields.
So we're expecting more inflation and more growth, and that means that people don't want to hang on to their bonds anymore.
Yeah, so you can divide the bond yield into two parts. You can think of it as being the inflation compensation or break-even inflation and the real yield. Now, what's happened since the election outcome is that break-even inflation has jumped significantly as people expect inflation to be much closer now to the target that the Fed has than they did before. Real yields likewise have risen, but not quite as much, and the combination of these things together has so far been worth about 40 basis points on the nominal 10-year yield.
Okay, so this is a US event. What's been happening in the rest of the world? Has it had a feed through to global bond markets?
Well, it has had a feed through. You might say, okay, so I can understand that now we're going to have more fiscal stimulus in the US, we're going to get higher nominal GDP in the US, we're going to see higher yields in the US. But obviously none of that is affecting Europe directly. But if I change this to the Bund yield, you can see that likewise the Bund yield has climbed as well, albeit to a lesser extent.
So bonds around the world are rising. This is good news for who and bad news for who?
Well, the yields are rising. If they're rising for the right reason, it's good news for the whole world economy. If they're rising because this great spectre of deflation, which we've been worried about for so long, if that is now looking less likely, I guess we would say for the economy as a whole, this is going to be good news. I mean, in the more prosaic near term, I guess people who owned bonds 2 weeks ago are looking at a capital loss because they're worth less today.
And let's look at the Eurozone in particular. So for Italy, I think this hasn't been a particularly good week for them. So the spread between the yields in Italy and Germany have gone up quite sharply, haven't they?
They have. This is your chart of the spread between Italy and Germany, and as you can see, we've had a rise here too. So what's that about? I think it's about two things. We do have political risk in Italy, which we've known is coming in terms of the upcoming referendum. And I think what we've seen in a variety of votes is taught the markets to be skeptical of the polls, and in particular to fear the more populist, less establishment outcome. And for Italy, that would mean a no vote in the upcoming referendum to Renzi's reforms. And as you can see, the market's now expecting that this increased political risk deserves more pricing in to a greater extent.
Laurence Mutkin, thank you very much.
Thank you.